All right. Hello, everybody. This is Mike Rixey. I am the lead options instructor for NetPIcks, and this is our weekly options recap. In today's video, a lot of interesting topics to cover. We've got earnings season that has really started to pick up. We've had all the financials release their earnings. We had a few of the big tech stocks here this week as well. But next week, the next 2 weeks really are going to be huge. A lot of the big heavy hitters in the NASDAQ are going to be releasing their earnings. So we'll talk about that here in just a moment, how that impacts how we trade over the next 2 weeks. It can certainly have an impact on the strategies that we use, the markets that we look at. So I'll walk you through our thought process there as well. We'll also take a look at some of the key index products that we track, try to get a feel for what to expect going into next week's trading. And I'll highlight a couple of the trades that are really sticking out to us going into next week. So let me go ahead and turn my camera off here a second so I can make my charts bigger. All right. So we always like to start out with a chart of SPY. This is the S&P 500 ETF. It's the big one, right? It's the market that everybody looks at. Maybe you're not trading it directly, and that's fine. But most people, whether you're a day trader or a swing trader, you're paying attention to the S&P because it's a good gauge on what the overall market is doing. I'm not necessarily using this exact daily chart to determine my entry and exit points. It just helps me determine how aggressive or conservative I want to be. How big is the volume? What does the range look like? What is the volatility looking like? All of that comes into play when I determine what strategy I want to use. It's not a situation where I just come and I say, I just want to buy calls or I just want to buy puts. I want to make sure I'm taking what the market is giving us. So when we take a look at this chart of SPY, it's been on a phenomenal run to the upside. We've talked about that now for the last number of live sessions that we've done. Here we are this week. We made a new all-time high yesterday, right at the 385 level. No surprise that we stalled out right there, at least temporarily yesterday. We stalled out right at 384.95, right in front of that big round number. Very common. We talk about those big round numbers. We talk about the 0.50 levels. They tend to be respected really well by especially the index products, and SPY, at least for the moment, stalled out there yesterday. Now, where does that leave us going into next week? Notice how on these moves to the upside, as we continue to make highs, number one, has not been broad-based buying. Right, this latest move to the upside, it's been all about the NASDAQ. Again, the tech stocks have really led the charge. The volume down at the bottom, notice here for just about all of this week, it has been a struggle on the volume side. It's been a struggle to hit 50 million shares. Ideally, we would like to see that closer to 100 million shares long term. In order for that to happen, we have to get some selling. Right? Everybody's long. Everybody that wants to be long already has all their bullish positions on. We're just kind of stuck in this holding pattern, right? I mean, no one's really aggressively getting long, and rightfully so here. The market is incredibly extended, but also no one wants to sell. No one wants to play the downside because every dip continues to be bought up almost immediately. And as a result, we are just left in this holding pattern at the moment. Ideally, going into next week, I would love, at the very minimum, I would love to get down and test the 8-period exponential moving average. That is that solid pink line there on the chart. It is currently sitting at 380.75. If we're going to get any meaningful selling here next week, we need to, at the least, break that level on a closing basis. If we break that, there is a massive amount of room to the downside here. Right? We have not seen any type of profit taking now for months. Going back to end of October, early November is really the last time that we saw any type of meaningful selling. There's a lot of room on the downside. If we start to get some selling to kick in here, that exit is not very big, right? I mean, you're going to have a mass run to the exits, in my opinion. And I think that could be a very tradable move on the downside. So on the downside, the first area of support, again, 380.75. If that level breaks, we do have this little air pocket down to the 20 period. Moving averages, both the simple and the exponential. So the two green lines there that are hovering right around 376. That would be another target on the downside should we get anything moving lower. And then, of course, on the upside, if we do continue to see this market rally higher, that all-time high right at 385 is a near-term area of resistance. Above that level, 385.50, 386. Those are going to be the next areas that we'll want to watch higher. The VIX, if you take a look at volatility market-wide here, is still hovering above 20. We've been that way really since March of last year. We have not seen any significant moves lower in volatility. This is an all-time record for an extended stretch this elevated. I expect it to stay elevated now, at least for the next few weeks, for a couple of reasons. Number one, the market is so overbought. We're so extended here. And then also going into earnings season, especially with the NASDAQ stocks, Apple, Amazon, Facebook, Google, with all of them releasing their earnings over the next few weeks, the market is pricing that in, right? So what that means is individual options right now are very, very expensive. Some of you have noticed that. You take a look at Apple, you take a look at Amazon, you take a look at Google. I mean, they have high priced options in most cases anyway, but it's elevated now because we're going into earnings season. So it's going to be very expensive to put on any type of a long option. That's why we continue to take a look at a lot of vertical spreads right now, just looking for the cost savings. And I'll talk about that more in just a moment. Down at the bottom, we have the yellow line there. It is the ATR, or the average true range. And you can see that it continues to move lower. We have gone from a high up around 7 back in early November of last year to now we're trending lower again down towards 4. As we continue to see the average true range contract, it typically leads to a slower, duller environment. That's what we've seen here lately. We have not seen a lot of intraday movement back and forth. It's just been a lot of slow, monotonous movement to the upside. If we're going to get things to pick up here, again, we need the volume to pick up. We need to see some selling, which is across the board. I can't have any pockets of strength. We can't have Apple up. We can't have Facebook and Google up. You take a look at the market here today. Why aren't we selling off here more than we have today? With Apple up another $1.50, it's going to be very difficult to get any movement on the downside. If we're going to get a meaningful sell-off, we've got to be able to look at this watch list on the left-hand side and not see any pockets of strength. You can't see Apple up $1.50. You can't see Google up 16. It's not going to do it. We're just not going to be able to get things to roll over. So some things that I'm watching into next week, want to see some selling pick up, want to see some volume come back into this market. And then ideally, I would love to see this ATR start to uptick a little bit. Start to see things intraday open up a bit. See some better back and forth movement to work with. All right. Now let's also talk, since we're talking about current conditions, let's talk about, let me pull it up here. Let's talk about GameStop. I've had a ton of questions come in on GameStop. So I'm just going to load up a 5-minute chart here on GameStop. I mean, it's been on an absolute tear the last few days, but specifically today. I mean, I've been trading for almost 20 years now, guys. I feel like I've seen just about anything the market can throw our way. GameStop, what we saw today, ranks up there, I would say, in the top 3 to 5 all-time moves. I mean, it's unlike anything that you will see. I mean, you take a look at this move higher. This type of a chart pattern is very typical in penny stock land. For a stock to move higher 30, 40, 50, 60% in a session, it can happen on a penny stock. GameStop is not a penny stock, right? I mean, you take a look, it's a $3 to $4 billion company, right? It's a pretty decent sized stock. And what we saw here today, I mean, we saw a brief move down to around 42.5, and then we shot higher to up over 76. That is one of the all-time short covering rallies you will ever see. That's a huge move. During this push to the upside from 60 up to 76 during this stretch right here, that happened in about a half-hour stretch. And the stock actually got halted, I believe, 3 separate times. And what happens there is when you start to see that type of intraday volatility, that type of movement, they will halt the stock for a few minutes just to let things settle down a bit because it was a runaway train here on the upside. I had so many questions because we had positions on, number one, which I'll talk about in just a moment. But when you start to see a situation like this, do you do anything? Do I do anything new? Let's talk about that first. Do I look at this as an opportunity to say, hey, we can't possibly head higher from here. Let's go ahead and put on a short position, try to play the move down to the downside. The trouble with that approach, there's a couple of issues. Number one, this is moving so quickly. I mean, it was moving literally $2 or $3 at a clip. You blink and it was up $2, $3. Makes it very, very difficult to chase. Now, if we go over to the trade page, and we can take a look both at the monthly options, we can also take a look at the weekly options as well. But some things to point out here As we start to get above $60 a share, I mean, look at these strike prices here. There's not a lot of strike prices available, which makes sense. I mean, market makers were not expecting a 60% move intraday on an individual stock. The strike prices are few and far between once you start to get above 60. There's not a whole lot available there to trade. You can also see, and they've really tightened up over the past hour or so, but during that move to the upside, the bid-ask spreads between on the options, they were really wide, making it very, very difficult to get fills on trades. If you were in positions, you probably saw your P&L all over the map. I had some panic calls from customers today because they saw things that they weren't expecting on their P&L. When they start to halt a stock like this, it's going to cause a lot of funny prices on the option side. It's one of the reasons why I like to be in risk-defined trades at all times. I don't like to take undefined risk for situations like this. Now, this was a historic move. This is not a move you're going to see every week, but it can happen. Today's a perfect example that it is possible. And what I don't want to do is get caught with undefined risk and be left with a large loss on a trade that moves against me. When you start to see that type of movement, they're also going to pump up the volatility. And who's they? The market makers are going to pump up the volatility. Look at the implied volatility numbers on these options. On the right-hand side, inside of Thinkorswim, you're going to see all these yellow numbers. It's the implied volatility that's being used to price the options. You take a look at the weeklies. 191% implied volatility. You start to go out a few weeks. Okay, you go out to next week's options, a 330% implied volatility reading. Okay, what that means is over the next 7 days, market makers are pricing in a $25 move on GameStop. It's only a $60 stock. They're pricing in almost a 50% move in the stock price over the next 7 days. That's extreme. What does that mean? When they start to price that into the value of the options, it doesn't mean you can't make money. You need a lot to go right in your favor. Okay, if you're going to buy an option here, you need a big move on GameStop to make money, because in a normal market, GameStop moving a couple of bucks, that's a decent size move. They're pricing in a $25 move over the next 7 days. That's huge. Instead of just trying to buy a put option, hoping to pick the top and hoping for GameStop to move lower, the much better choice here, in my opinion, is to put on a credit spread. Selling an out-of-the-money call spread, for example, if you want to lean bearish. Because what you're doing there is you're taking advantage of the high option prices. You're not buying those options, you're selling them. So you're able to collect more upfront, and you're putting volatility in your favor. We know that a 330% implied volatility level in a weekly option is not sustainable. Okay, they're pricing in a lot of uncertainty just due to the headline risk here that is in GameStop currently. Over time, over the next couple of weeks, in all likelihood, that volatility is going to want to contract. Okay, it's going to want to start to head back to the downside. And as volatility contracts, it's going to cause the options to lose value. That benefits us if we use a credit spread. It hurts us if we buy an option. If we just buy an individual put, if volatility contracts, it's going to hurt us in a big way. So taking what the market's giving us, let's go out and take a look at GameStop. Let's just take a look at the options here and see if there's anything there that we could take advantage of. Let's go out to the February monthly options, the ones with 28 days left. And actually, no, we can't do that because we don't have any strike prices available out there. I just got done talking about that and I already forgot about it. So basically going out to February, you can see that past the 60 strike, there's nothing available there. So we're going to go to the weeklies. Let's just go out to, we could certainly take a look at the options with 7 days left. It's a little aggressive. I'm going to go out to the February 5th options. And then we still don't have any strike prices there. Let's see. Do we have any? Well, let's just take a look at the January 29 options. The problem here, guys, is until they start to add those strike prices, which they will going into next week, we'll have more strike prices available. We're kind of limited in what we can look at on the credit spread side of things. So another option would be just to wait until Monday or Tuesday next week when we have a wider range of strike prices available. We could do that. But let's just, for our examples here today, let's just use the January 29 options. They have 7 days left to expiration. Let's go out to the 65. Let's go out to the 65 calls. Let's right click on those, go to sell and go to vertical. It's going to pop up an order down at the bottom where I would be selling the 65 call and buying the 70 call at the same time. That would leave us with a risk-defined trade. Like I talked about a few moments ago, I don't like undefined risk here, especially on GameStop. We've already seen it today. Extreme moves can happen. I'd rather define my risk, even though I'd be giving up some profit potential. I'm okay with that, given that I can go ahead, reduce my risk, reduce my capital required to put on the position. And let's just say for our example here, let's just say that we can get filled. Markets are kind of wide in here. Let's say we get filled at $2.25. What does that do for us? It allows us to collect $225 per spread. It would require $275 of our capital to put the trade on. All right. That's the most that I can lose on the trade. Okay. So that's my maximum loss on the trade. The most I can make is $225. The only way that I can make that money is if GameStop closes below 65. Any type of a move lower over the next 7 days would help us make money faster. If we don't see a big move lower, what if we just start to chop and consolidate here? We can still make money there too, because the time decay is adding up. And if during that time the volatility decreases, all of that comes into play and it helps us make money faster. Okay, so up, down, or sideways, we're okay on GameStop over the next 7 days as long as price stays below 67.25. That's our break-even point. The current price of the stock's at 59.5. So we'd have about an $8 cushion, between a $7 and $8 cushion, that this thing could move against us on the upside and still be okay. It's a pretty wide range there. We also make money from that time decay adding up and from the volatility decreasing. So now there's 5 ways of making money on the position. So that's one of the trades that could be on the radar for next week. You could put it on this afternoon. You could wait till next week, wait for those additional strike prices to be available. Wouldn't have a problem there either. One thing that I will point out is look at the bid-ask spreads here. Okay, I mean, there's between a $3 and a $4 difference between the bid and ask on the 65 calls. These are wide markets. If you're going to place a trade here on GameStop, be picky on your price. Okay, it's going to be all over the map. I would rather get filled at a good price or not at all. So my approach here on GameStop, my plan of attack, what I wanted to do is just walk you through an example of how we would piece the trade together. What I am looking to do is most likely waiting till Monday, following the same criteria, looking for an out-of-the-money short call spread on Monday. But I'm going to wait because I want to see markets tighten up a little bit. I want to see those bid-ask spreads tighten up a little bit. Wait for things to settle down a bit on GameStop with the credit spread. You know, we don't need to try to paint the top here. With time decay helping us, we can be patient. So I would hold off. At least that's what I plan on doing myself. And let me pull up a trade that we actually had on. Sorry, guys, I'm trying to pull up my spreadsheet here so I can get the exact details. So the trade that we put on yesterday afternoon, GameStop has been active all week. It's been on a phenomenal run all week. Today was kind of the icing on the cake on the upside. But what we did yesterday afternoon is we came in and we sold the 43 of 45 call spread. It's this one right here. And we collected 60 cents or $60 per spread to put the position on. It gave me a risk of around $140 per spread. It's a fully risk-defined trade. The reason I want to point this trade out because this is the cause for a lot of the panic calls today that I received. Because GameStop was up 60, I believe it was 65% at one point in the session, right around lunch, just after lunch. I had people calling saying, what do we do here? The in the money option, the 43 call, it's very deep in the money. And people were concerned with that option. What I want to point out is the benefit of using a spread is we know the maximum loss on the trade. I can't lose more than $140 per spread on this trade. That's it. Even if it goes to $100 a share, I'm still in a defined risk trade. Here's how it works. I am short the 43 call, but I also bought the 45 call. Me buying the 45 call defines my risk. So now, how do I close the position out? There's a $2 difference between the strikes. If we bought the spread back for $2, it would close the entire position out and it would leave me with $140 loss per spread. The problem with that is because the move has been so extreme today, it's been difficult to get fills on the trades. So what if we just held the trade? What would happen at the end of the day? If markets closed right here, if GameStop closed at $58 a share, what would happen? The 43 call that we sold, that would get assigned. The 45 call that we own can be exercised. And all that means is the entire position goes away. We take the full loss on the trade. The outcome of the trade would be no different whether we buy the spread back to close it out or just hold it to expiration. The entire thing would go away. We would close out of the position and have that $140 loss per spread. So when this type of a situation happens, it doesn't happen all that often, but when it does, and when stuff hits the fan like it did today, you have to remember that we're always in a risk-defined trade. This is a prime example of why we prefer to use spreads as opposed to just selling individual options. It leaves us with a situation where we know what the maximum loss is up front. Sure, no one likes to take a loss. It wasn't fun to take the loss, but in this type of a situation, we are fully risk-defined. Okay, so if you're a customer, for example, if you've got this position on, if you can't close it out at $2 at the end of the day, don't panic. Okay, the 43 call will be assigned. The 45 call can be exercised, and that's going to be done automatically by your broker. So the whole position will just go away. You're going to be flat, and you'll be left with no position on going into next week. All right, so that was one of our overnight trades that we took yesterday afternoon, and obviously, I mean, to expect a 60% move overnight, I mean, that's a historic move. It ranks up there with all-time moves here today. So yeah, it wasn't a fun situation, but we'll see if we can get another trade or two on GameStop next week, see if we can start to battle back there after the loss this afternoon. The other trade that we put on an overnight pop trade on QQQ, which is the NASDAQ ETF, and we put this one on yesterday afternoon. The overnight pop trades, we're looking to put on a position the afternoon before expiration, and then the goal is to close these trades out during the first couple of hours of the session on expiration day. What we did on this trade yesterday afternoon is we sold the 327.5, 329 call spread. So let me go ahead and load this trade up down at the bottom. All that means is I'm selling the 327.5 call and we're buying the 329 call at the same time. We opened this spread yesterday for $145 per spread. I'm sorry, for $45 per spread. It gave me $105 of risk per trade, per spread. It's currently trading for 5 cents. We actually closed this trade out earlier today for around 11 cents. So it gave us a $34 profit per spread. Remember, we only tied up $105 of our capital to begin with. So we're looking at a 30% return on our capital overnight. Really nice trade. Now, how did we make money? All we needed was for QQQ to stay below 327.5. That's the strike price of the call that we sold. The current price is at 325.81. So we're below. It hasn't been a huge move lower today. It's only down 50 cents, and that's a pretty small move compared to what we've seen lately on the upside. But that's all we needed. That's the beauty of using a credit spread, especially close to expiration. The time decay is extreme. The volatility movement can be extreme, and it allows us to make money overnight, even when we don't get a big directional move in our favor. Had some questions on this one here today. Also, why wouldn't we hold all the way to the end of the day? That way we can book the full profit on the trade. The problem with that approach is when you get this close to expiration, the gamma also is extreme. And the gamma tells us how quickly the options are going to react to changes in stock price. And if we hold all the way to expiration, here you go into this afternoon, what if we get a rally into the close? We've seen it so often over the last few months. We get into the afternoon session, get into the end of the day, and the market starts to rally back higher. I don't want to let this thing go from a nice winner to a loss, which can happen in a hurry that close to expiration. I prefer to close the trade out. If you're using Tastyworks, which is what we do on our side, they don't charge a closing commission. So it's not going to cost us anything to close out of the trade. And it just allows us to book the profit, free up the capital for the next trade, and also not require us to sit there and be glued to the screens all day long. So we ended up closing out of the trade for a nice profit. So, a winner and a loser here on our overnight pop trades from yesterday afternoon. And now let's take a look at some additional charts. Let's take a look at some markets that we are tracking and going into next week. And we've been just been talking about the index products. So let's just start there. Let's start out with QQQ. This is the NASDAQ ETF. Next week, actually the next couple of weeks, are going to be very earnings centric. So Apple, Amazon, Facebook, Google, Microsoft, we've got earnings galore. I don't like to trade those individual stocks through earnings. It's just not my style. Too much has to go right in your favor. It's just not something that I have found good results with over time. But I am willing to trade QQQ because it is an ETF. It's not an individual stock. Yes, QQQ is going to be heavily influenced by what Apple does, by what Amazon, but what overly exposed. It's a much safer approach. So QQQ going into next week, we are overbought. Let's just take a look at this 195-minute chart. I mean, you can see going back to early November, we've basically gone from around 267 all the way up to a high this week of 327. That's a huge move because during that stretch, we've had very little selling at all. I mean, we've had, 2 days of back-to-back selling maybe once or twice in that span. We are very, very overbought. What does that mean? Going into earnings, there's a lot of good news that's already being priced into this market. It doesn't mean we can't head higher from here. It just means it's going to be more difficult. It could certainly lead to a sell the news type of an event. They have been buying this market nonstop on rumors, right? Buy the rumor of more stimulus, buying the rumor of the tech stocks being unstoppable, right? But now you get into earnings, everybody's banking on the fact that Amazon's going to have great earnings with the pandemic leading to everybody shopping online. But what if that's already priced in? What if we start to see a sell the news type of an event? Could very well see that playing out. At this point in time on QQQ, on any of the index products, I don't like these levels for initiating new long trades. Not going to do so myself. In order for me to buy a long put here, I want to see some selling confirm. At the very least, I'd love to see price action close below the AEMA. That's the red and the blue line here. So I'm not going to take a look at any type of a long position, not going to take any type of long put position here. But this could potentially be a candidate for selling an out of the money call spread, putting on a credit spread. That way we're putting time decay in our favor. If price action just starts to chop and consolidate here, we can make money from that type of a move. Now, I'm not doing anything to end the week here on QQQ, but it is going to be on my radar for next week, potentially getting a trade on that I would plan on carrying through some of those earnings numbers out next week. SPY, the S&P 500 ETF. We already talked about it over on the daily chart. The 195-minute chart is going to give us 2 candles a day instead of 1. It just speeds it up a little bit. It allows us to better identify the setups. And everything I talked about on QQQ holds true for SPY as well. We're very overbought. We have gone from a low back in November down below 325 to all the way up here this week at that all-time high up around 386. I mean, it's been a huge move. Price action here on the lows this morning, you can see that we did test the AEMA. Let me try to zoom in here, see if it'll zoom in for me. You can see that we tested that AEMA almost to the penny and bounced off of that level. That's a very key level that we want to see broken. If it breaks, I'm more than willing to consider potentially some long puts at that point, looking to play a potential move down towards the 50 EMA, which is the yellow line. That's something that I'm watching next week. As far as initiating new long trades here, I'm not interested. Not going to do so myself. I'm not going to continue to chase this move. Okay, so I'm more than willing to sell out of the money call spreads here in the near term. And then if we do start to finally get a much needed pullback going into next week, we'll take a look at adding some long puts at that point as well. One of the tech names, one of the NASDAQ names that has already released earnings is Netflix. This is one that definitely is on the radar for next week. After earnings were released, Netflix saw a pretty impressive rally higher. It has left the stock very overbought in the near term, but we haven't seen much in the way of selling here. Yes, we're down $11, down almost 2% today, but when you put it into context of what we've seen big picture over the last couple of weeks, I mean, a 2% move lower, it's a drop in the bucket after this huge move higher after earnings. We are very overbought. How do we quantify that? The yellow bars here on the pulse indicator indicate an overbought condition, indicating price is between a 1 and a 2 standard deviation move on the upside. Doesn't mean we can't head higher from here. It just means it's not statistically probable. Odds favor either a period of consolidation or even a reversal lower. What has happened since we started to get those yellow bars? See how price action has started to consolidate here. And even over the last 24 hours, we have started to see things roll over a bit. Okay, now, am I expecting Netflix to completely fall out of bed here? No, I'm not. I could certainly see a healthy pullback, maybe some consolidation. So one way of playing that is, again, to sell an out of the money call spread. So let's go over to the trade page on Netflix. Let's take a look at the February monthly options, the ones with 28 days left to expiration. Let's go ahead and open those up. If I come in and buy a long put here, you're talking about between $1,500 and $2,500 just to buy a long put. They're expensive. I talked about that earlier. If we come in and sell an out of the money call spread, let's take a look at selling the 590, 595 call spread. That means is I'm selling the 590 call and I am buying the 595 call at the same time. It's a fully risk-defined trade, so I know what my maximum loss is right up front. If we collect $150 per spread, which is the current price of that spread, we would be risking $350. We're right around risk 2 to make 1. What I'm looking for here, we make money as long as Netflix stays below 591.5. That's our break-even point. The current price is sitting at 569. We've got about a $20+ cushion here on the upside where Netflix can continue to move higher, and we're still okay. The only move that hurts us is a big move above 591.50, which we're not expecting because the market is already overbought. We just took a look at that on the 195-minute chart. Any type of a move lower helps us. If it's a move sideways, we're okay with that as well. And if it's a slight move higher, we're okay. All 3 directional moves, we're okay. We also make money as time decay adds up and if volatility decreases. So now there's 5 ways of making money on the position. All right. We're instead of tying up $2,000 of capital per contract to buy an individual option, we're only tying up $350. This trade can be taken with a small account. And if we're dead wrong and the market continues to plow its way higher, the most I can lose is $350. So it's a very safe position to be in. So that is one of the trades. And I would be okay. I am planning on looking at this trade. I'm planning on looking to get it on here yet this afternoon. Well, we should get a burst in volume in the last hour of the session. We always do. I said we'll make it easier for us to get filled on a trade. So that is one that is definitely on my radar. Don't have to worry about earnings any longer, which is nice. Definitely seeing an overbought condition on the stock. So that is one that is on my radar. That is one of my favorite setups for next week. I will absolutely, if I can't get it on this afternoon, I'll absolutely get it on here Monday morning. A couple other markets before we wrap up. We've got an interesting stretch here on the metals. If you take a look at silver, you take a look at gold. I do believe that we are getting ready to see a very tradable move here. This is the silver ETF, SLV. And notice what's happened the last couple of weeks. I mean, we've just started to settle into the sideways stretch. It's what we call the coiled spring pattern. Price action has just been straddling the moving averages here, both the 8 and the 50 EMAs. At some point in the very near future, we're going to see price action break away from those levels, and I think it's going to be a very decent sized move. I think it's going to be a very tradable move. Now, we don't have any type of setup here as of yet. Want to wait for price action to confirm. Ideally, I would love to see this thing move higher. In theory, if we start to see gold and silver move higher, it's probably because equities are selling off. So that would be a good thing. So silver is on my radar for next week. I want to see price action break first. So we'll take a look at this when we do our midweek update on Wednesday next week. See if we get any type of movement there. See if we see any type of a break away from those moving averages. See if we can get a position on. So nothing to do here today on either silver or gold, but they are definitely front and center here for early next week. And GLD, I like to trade the gold ETF. You've also got the gold miners ETF, which is GDX. Wouldn't be opposed to trading that one either. I prefer GLD here. And you can see price action, again, just kind of moving sideways the last couple of weeks, just having a hard time breaking away from those moving averages. But if we can get that break over the next week or so, we'll absolutely be looking at putting on a position. I like to trade both silver and gold. I will trade both. If you had to pick one or the other, I have found that gold is an easier product to trade. So GLD over SLV if you had to pick one. Both are good products. I have had good success trading both. So ideally, if you can trade both, that'd be great. But if you had to pick one or the other, GLD, in my opinion, is the better product. So I'm looking for more of a directional trade here. You could use a credit spread, but I'm more looking for either a long call or long put, depending on which way this thing breaks. So again, we'll revisit it again Wednesday of next week for our midweek update. So if you can join us on Wednesday, we'd love to have you. Then we'll take a look, see if we can get a position on gold or silver. So as we go into the close here today, just go back over to our 5-minute chart. You can see price action pretty choppy over the last couple of hours on SPY. Just kind of, again, that spring is coiled pretty tight here. Could we see a move into the close? Sure. I mean, it's setting up for a nice move into the close, but we'll see what happens. I mean, we know Friday afternoons have been pretty reliable for rallies into the weekend. So we'll see if we get another push to the upside going into the close this afternoon. And then next week, I think the next couple of weeks, guys, are going to be very, very busy. Markets are going to be very active with all the earnings numbers, with more stimulus news out potentially next week. It's going to be a prime time to be active. So if you have any questions over the next few days, over the weekend, let me know. Feel free to email me directly, mike@netpicks.com. If you are reviewing the video, the recording on YouTube or Facebook, you can email me or leave a comment on the video and I'll get back with you right away. So if you have any questions, go ahead and get those in now for those of you that are joining us live. Otherwise, I'm going to wrap up here for the day and for the week. Enjoy your weekend, everybody. And we'll hit the ground running here early next week. We'll talk to you then.